So last week, Pew Research had a new poll that came out tracking how many people call themselves middle class versus some other class. Now, famously, in this country, people don't have a real sense of what the income distribution is in this country. You've seen the studies where people say, how much do you think is controlled by the top 1%? And they are completely wrong. They have no idea exactly just how lopsided our income distribution is. However, there's no real reason why people should they may misidentify themselves, but there's no real reason why they should change that identification unless things move in an appreciably more advantageous or detrimental way for them. Kevin Drum did some digging into these numbers. If you look at the numbers of the people who identified as middle class in 2008, nearly 1/3 of them now identify as lower, middle, or lower class. About 1 in 6 Americans now think of themselves as not just suffering an income drop, but suffering an income drop they consider permanent. Permanent enough that they now live in a different neighborhood, associate with different friends, and apparently consider themselves part of a different culture than they did just 6 years ago. Poverty, obviously, a huge problem in this country. But we also have a huge problem of the middle class being completely hollowed out. This piece in the New York Times today makes it clear that this is a fact not just being noticed by people themselves, but by the people who would market and sell products to them. PricewaterhouseCoopers, which is a global retail and consumer practice, are now telling clients like big stores, restaurants, to chase after rich customers with a wider offering of high-end goods and services, or focus on rock bottom prices to attract the expanding ranks of the penny-pinching consumers. John G. Maxwell, the head of the global retail and consumer practice at PricewaterhouseCoopers, says, as a retailer or restaurant chain, if you're not at the really high level or low level, then you're in a tough place to be. You don't want to be stuck in the middle. And the reason is because nobody's there. Research by the economist Stephen Ferrazzari of Washington University in St. Louis and Barry Cinnamon of the Federal Reserve Bank of St. Louis backs up what is already apparent in the marketplace. In 2012, the top 5% earners were responsible for 38% of domestic consumption, up 10 percentage points from 1995. The current recovery has been driven almost entirely by the upper crust, according to Fazari and Cinnamon. Since 2009, the recession year ended, inflation-adjusted spending by this top echelon has risen 17%, compared with 1% among the bottom 95%. We know that 95% of income gains during that same time have gone to the top 1%. So this should be of no surprise. More broadly speaking, 90% of the overall increase in inflation-adjusted consumption between 2009 and 2012 was generated by the top 20% of households in terms of income. This according to the study. Fazari also says, depending on a relatively small but affluent slice of the population to drive demand makes the economy more volatile, because this group does more discretionary spending that can rise and fall with the stock market or track seesawing house prices. This is fairly obvious. It's the same dynamic, frankly, with with this show. You know, I love it when we get big donors to this show. We had early on to help us launch a Sam Seder. Or I don't know if we ever had a French member, but a professional leftist. But I would rather, 10 members at the $10 level than one member at the $100 level, which is not to say don't become a $100 level member, but of course you want it evenly distributed because it means less volatility. A $100 member loses their job or something, then all of a sudden we lost 100, but it's harder for 10 people to lose their job. So it makes sense. Investors have taken notice of the shrinking middle, as it were. Shares of Sears and JCPenney have fallen more than 50% since the end of 2009. But upper-end stores like Nordstrom and bargain basement chains like Dollar Tree and Family Dollar stores have more than doubled in value over the same period. John Glass, a restaurant industry analyst at Morgan Stanley, with diners paying an average tab of $16.50 a person at Olive Garden, the customers are middle class. They're not rich. They're not poor. With income growth stagnant and prices for necessities like healthcare and education on the rise, he said, they are cutting back. On the other hand, at the Capitol Grill, an upscale Darden chain where the average check per person is $71, spending is up by an average of 5% annually over the last 3 years. Wowza. So there you have it. And what are we seeing in terms of addressing what's going on with the middle class? The pushing of a so-called trade agreement, which will make it harder for things like the government negotiating on prescription drug bills. Make it impossible, really. Things like lowering consumer protection and corporate liability standards in terms of regulations and an environment. Seeing hedge funders buy up a lot of rental properties, turning them into slums, essentially, driving up the price of rent. So we're not seeing much to deal with that problem, frankly, from my perspective.